Hello and welcome to Investor Web, your trusted guide on all things finance and investments. Here we aim to empower you with the knowledge to navigate the ever-changing world of finance. We unravel complex topics, explore investment strategies, and offer insights into the global economy. From the seasoned investor to the curious novice, our content is tailored to enlighten and educate. So buckle up and join us on this exciting journey of financial enlightenment. Stay tuned as we delve into today's topic: can you survive a financial crisis? To navigate a storm, one must first understand its nature. So what exactly is a financial crisis? A financial crisis, in simplest terms, is like a domino effect in the world of finance. Imagine a row of dominoes, each representing different aspects of the economy: banking, employment, stock market, and so on. If one domino falls, it can trigger a chain reaction, causing the others to topple over. Let's delve a bit deeper. A financial crisis often begins with a disruption in one part of the economy. This could be a sudden drop in property values, a sharp rise in oil prices, or even a global pandemic. This disruption then ripples through the economy, leading to a decline in consumer confidence, a fall in investment, and a rise in unemployment. These factors collectively cause a severe downturn in economic activity, which we term as a financial crisis. Now, you might be wondering, how does this affect me? Well, a financial crisis can have a profound impact on individuals. It can lead to job losses as businesses cut costs to survive. It can reduce the value of your investments as stock markets tumble. It can make it harder to borrow money as banks tighten their lending criteria. And it can increase the cost of everyday items as inflation rises. But here's the catch. While a financial crisis can be disruptive, it's not necessarily disastrous. Yes, it can shake up the economy, but it can also create opportunities. For instance, lower asset prices can present buying opportunities for savvy investors. And downturns can spur innovation as businesses strive to adapt and survive. It's also worth noting that financial crises are not a new phenomenon. They have occurred throughout history, from the Great Depression of the 1930s to the global financial crisis of 2008. Each crisis is unique, but they all share a common trait. They are cyclical in nature, and they inevitably lead to periods of recovery and growth. Now that we know what a financial crisis is, it's time to learn how to survive one. The first step to surviving a financial crisis is having an emergency fund. Now, you might ask, what is an emergency fund? Well, it's a stash of money set aside to cover the financial surprises life throws your way. These unexpected events can be stressful and costly. Think of it as your financial safety net. Why is an emergency fund important, you wonder? Picture this. You lose your job tomorrow, your car breaks down, or a sudden medical emergency arises. In such situations, having an emergency fund can be the difference between a temporary hardship and a financial catastrophe. It provides you with a buffer, ensuring you don't have to rely on credit cards or loans, which can lead to a nasty cycle of debt. So, how much should you ideally save in your emergency fund? Financial advisors typically suggest that you should have between 3 to 6 months' worth of living expenses saved up. But remember, this is a guideline, not a hard and fast rule. Your personal circumstances might require you to save more, or perhaps a little less. Now let's talk about how you can build this fund. It's simpler than you might think. Start by setting a monthly savings goal. This doesn't have to be a large amount. Small, consistent savings can also lead to a significant emergency fund over time. Next, consider setting up automatic transfers to your savings account. This way, you're saving without even thinking about it. And finally, whenever you receive unexpected money like a bonus or a tax refund, resist the urge to splurge. Instead, direct a portion of it towards your emergency fund. Remember, the goal is to build this fund at a pace that's comfortable for you. It's not a race, but a journey towards financial security. An emergency fund is your first line of defense in a financial crisis, but there's more to it. So stay tuned as we delve deeper into the other steps to survive a financial crisis. Trust me, you wouldn't want to miss it. Next, let's talk about diversifying your investments. Now, diversification, in its simplest form, is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. Diversification is the financial world's equivalent of not putting all your eggs in one basket. Instead, you spread your capital across different asset classes such as stocks, bonds, real estate, commodities, and even cash. This way, if one investment doesn't perform well, you won't lose all your money. So, why is diversification important, especially during a financial crisis? Well, during a financial crisis, certain sectors or industries may be hit harder than others. If your portfolio is too heavily weighted in these areas, you could face significant losses. However, by having a diversified portfolio, you can offset losses in one area with gains in another. Let's break this down with an example. Suppose you have a portfolio that is entirely invested in tech stocks. If the tech sector experiences a downturn, as it did in the early 2000s during the dot-com bubble burst, your portfolio could suffer a substantial loss. But if you had diversified your portfolio to include other sectors such as healthcare, utilities, or consumer goods, these sectors could potentially hold steady or even increase in value, helping to offset your losses in tech. Also, consider investing in different geographical locations. For example, if your investments are solely in the United States and the US economy takes a hit, your portfolio will likely suffer. But if you also have investments in Europe or Asia, you might be able to mitigate some of that risk. In essence, diversification helps to smooth out the bumps in the road. It's not about maximizing returns, but about minimizing potential losses. Remember, in the face of a financial crisis, preservation of capital becomes just as important, if not more, than capital growth. Diversification can help buffer against the blows of a financial crisis, but the strategy doesn't end here. The third step to surviving a financial crisis is staying informed. There's a saying that goes, "Knowledge is power." And in the realm of finance, this couldn't be more true. Staying informed and updated with economic news and trends is crucial in navigating a financial storm. Now you may ask, why is this important? Well, the financial world is an ever-changing landscape. New laws and regulations, shifts in markets, and global events can all significantly impact your financial health. By keeping your finger on the pulse of these changes, you can make proactive decisions rather than reactive ones. So, where can you get this vital information? There are plenty of sources, but it's crucial to choose ones that are reliable and accurate. Start with reputable financial news outlets. These platforms provide timely updates on market trends and economic news. Look at financial news websites, listen to finance podcasts, or read financial newspapers and magazines. These sources often feature expert insights and analysis that can help you understand the broader context of financial events. Don't forget about financial blogs and online forums. They can offer a wealth of information and different perspectives. However, be wary of misinformation. Always cross-check any advice or tips you find with trusted sources. You can also consider subscribing to financial newsletters. Many financial experts and institutions provide these, and they can deliver curated, in-depth information straight to your inbox. Social media is another tool that can keep you informed. Many financial experts and institutions have social media accounts where they share insights and updates. However, remember to use this medium responsibly. It's easy to get caught up in the noise and hype, so always take a step back and critically evaluate the information you find. Lastly, don't underestimate the value of books. Reading financial literature can give you a solid foundation and deeper understanding of economic principles and trends. Remember, the goal of staying informed is not just to absorb information passively, it's about engaging with the information, understanding it, and using it to make informed financial decisions. Knowledge is power during a financial crisis. Now let's summarize what we've learned today. Before we wrap up, let's quickly recap the steps to survive a financial crisis. Firstly, we discussed the importance of an emergency fund. This is your financial safety net, a cushion to soften the blow of sudden unexpected expenses or a loss of income. It's crucial to put aside a portion of your income regularly into this fund until you have a comfortable amount that covers at least 3 to 6 months of living expenses. Our second step was about diversifying your investments. Remember, it's never wise to put all your eggs in one basket. Spreading your investments across a variety of assets such as stocks, bonds, real estate, and even precious metals can help protect your wealth from the volatility of a single market. Finally, we emphasize the need to stay informed. Information is power, especially in the financial world. Regularly monitor the economic landscape, keep abreast of market trends, and be aware of global events that could impact your finances. But remember, these steps are not a one-time effort. They require consistent action and vigilance. Financial preparedness is a continuous journey, not a destination. Remember, the key to surviving a financial crisis is preparation. Thank you for tuning in to Investor Web. If you found this video helpful, please subscribe for more insightful content. Until next time, stay financially savvy.